All right, let's dive right in. According to the source we're breaking down today, there's a major emergency unfolding in the global silver market. It's a story about a system that's apparently cracking under pressure, and it all starts with one single, really shocking number that just came out of Shanghai. And there it is, $80.53. Now, our source is clear. This isn't some typo or a wild guess. This is supposedly the real verified price for 1 ounce of physical silver in Shanghai, based on the last closing price before a recent holiday. Okay, so this is where things get really weird. While Shanghai is apparently paying over $80 for physical silver, the paper market over in New York is pricing it at almost $9 less. Our source is adamant that this is not a normal spread. They're calling it a fundamental fracture, a sign that the market itself is actually broken. So that's the million-dollar question our source is asking, right? In any normal, functioning market, a price gap this huge is basically free money just sitting on the table. It should be an irresistible opportunity for traders. So why is it still there? Well, the thing that's supposed to fix this is called arbitrage. And the source has a great way of putting it. Think of it like the law of gravity for finance. Traders should be buying that cheap silver in New York and immediately selling it in Shanghai for a guaranteed profit, and in doing so, pull the prices back together. But the claim here is that this financial gravity has just been switched off. So what could possibly be powerful enough to break a fundamental law of finance? The source offers up a pretty chilling explanation. The arbitrage isn't happening because it can't. The argument is that the physical silver that's supposed to be backing the paper contracts in New York, well, it just isn't there to be bought and shipped. We're talking about a catastrophic breakdown in the physical supply chain. And that leads us to the big why. Why is demand so insane in the East that they're willing to pay this kind of premium? Well, the source argues this has nothing to do with financial speculation. The ones paying up are the industrial users who absolutely desperately need physical silver to keep their factories from shutting down. And this demand is apparently coming from two key sectors where China is an absolute global titan: solar panel manufacturing and electric vehicles. According to our source, these industries have basically entered a state of panic buying. You know, for years, the whole story in solar was about thrifting, finding clever ways to use less and less silver to save money. Our source says that game is over. They've hit a wall where if they use any less silver, the panels just don't work as well. And here's the kicker. The next generation of high-efficiency solar cells actually needs more silver, not less. And then you've got the EV sector. This is the source's calculation for the mind-boggling jump in silver needed for the new solid-state EV batteries. They argue it could take 20 to 50 times more silver per car than a standard EV. That is a massive multiplier. I mean, this quote from the source just says it all. For these huge companies, silver isn't just another commodity on a spreadsheet anymore. It's a critical, strategic component. They're willing to pay any price because the alternative, shutting down a multi-billion-dollar gigafactory, is completely out of the question. So, what's the direct result of all this industrial panic? Well, it's a massive, visible drain on physical silver inventories in warehouses all over the world. The cupboards, it seems, are getting pretty bare. This chart really puts it into perspective. We're looking at the silver inventory at the Shanghai Futures Exchange. According to the source, just a few years back, stockpiles were over 3,000 tons. Today, they're down to less than 800. That's a 75% drawdown. The physical drain is real, and it is happening fast. And hey, this isn't just happening in the East. Over in New York, the source flags this number: 1.4 million ounces. That's how much registered silver, the stuff officially marked ready for delivery, was pulled from a single COMEX vault in a single day. The source doesn't call that a withdrawal, they call it a bank run. All of this leads to a really crucial market signal called backwardation. It sounds complicated, but it's simple. It just means people are willing to pay more to get silver in their hands today than for a promise of silver tomorrow. Our source calls it the heartbeat of a squeeze, because the market is basically screaming that a severe physical shortage is happening right now. So all of this is setting the stage for the source's main prediction, a potential collision during Ghost Week. That's the notoriously low-volume, sleepy trading period between Christmas and New Year's, where this huge price gap could get resolved violently. The source lays out this potential four-step domino effect. First, you get the trigger. A real industrial buyer puts in a big order. Second, the vacuum. That order hits the thin holiday market and causes a huge price spike. Third, the algo chase. Trading algorithms see the gap and pile in to make a profit. And finally, the gamma squeeze. This forces banks who are on the wrong side of the trade to rush in and buy futures to cover their positions, creating a massive feedback loop that could send the price vertical. So what you have are these two totally different worlds. In one corner, you've got New York, a low-liquidity paper market that thinks silver is expensive. And in the other corner, you have Shanghai, a physical market that's desperate for critical metal, acting like a giant price magnet. The source claims these two worlds are on an unavoidable collision course. Finally, the source looks past this one potential event to ask what all of this really means for the future. I mean, if this price gap does close by rocketing upwards, what are the long-term consequences for the whole market? The argument is that the trust in the global supply chain has been shattered. We're seeing a fundamental shift in how big companies operate. They're moving away from a just-in-time model, where you just buy what you need for the week, to a just-in-case model, where you start hoarding months of supply because you're scared it won't be there tomorrow. And this really culminates in the source's main thesis, which is captured perfectly in this one line. For decades, the paper markets in New York and London set the price of silver. The claim now is that the power has shifted east. The real price isn't being set by traders anymore, but by the people who actually need the metal on the loading docks of Shanghai. And that leaves us with this final, massive question that the source poses. Is this $80 warning shot from Shanghai just a temporary glitch, a weird blip on the radar, or are we actually witnessing the end of the entire era of paper contracts setting the price for real physical metal?